Welcome, I'm Alvin Fan, CEO of OPIM. Alpha Uncovered is an interview series where we explore unique perspectives from some of the best investment minds in the hedge fund industry. Our goal is to find investment opportunities off the beaten path, uncovering real alpha. Remember, hit the subscribe button below and stay tuned with all the alpha generators to come. Our special guest today is a very interesting both quant and fundamental manager, a good friend of ours, Mr. Xin Wu, from Banyan Partners based in Shanghai, which allows him to cut through the noise and get real, unfiltered insights. We know Xin from his candid, no-nonsense take on navigating these markets, and Banyan Partners runs what we call a quantamental strategy, primarily long-short equities onshore in China that consistently ranks in the top quartile of its category. Prior to starting Banyan in 2013, Xin was a partner at 𝗜ሔር Partners, New Margin Ventures, and before that, an investment manager with one of JP Morgan's buyout funds. He began his investment banking career at Robertson Stephens and Company in San Francisco and received his master's and science degree in engineering and economic systems from Stanford University. Welcome, Xin.
Thank you. Thank you for having me, and thank you for your kind words.
So I want to jump into something that for us and some of the allocators that we work with, normally when we look at presentations that say private equity approach to public equities, it usually makes us cringe. And what's unique about your situation, you actually really do come from a private equity background. And you've somehow deployed that actually into a quantitative nature for your book. And just to give everyone a background, this fund has almost 10 years track record. It's one of the longest standing track records in China A-shares that we've come across. Your team has delivered incredible results from 2019, 2020, 2021. Had a bit of a drawdown last 2 years, but we're now coming into a rebound. Going back to the question, private equity approach to public equities, how is it that you're reconciling that into the public equity space, and where does the quant aspect come in?
Okay, yeah, that's a very good question. On the fundamental side, the private equity background, in our view, comes in two very important angles. Okay, everyone can claim that they are very investor and they follow closely to fundamental analysis, but we view from two angles that sets us apart. One is really in the mindset front, because you can easily sit in a meeting with the management and ask about the numbers from next quarter and quarter after that. But for us, we separate the research. When we look at a company, we need to decide if it's a good industry, if it's a good company, and whether it's a good stock. Three separate things. So the most important thing is to make a determination that, from a private equity point of view, it has to be a good company. And that particular company will come into our watch list, so to speak. Much smaller universe that we will monitor carefully. Now, a good company may not necessarily be a good stock if it's very expensive, for example. So that's the first thing. We instill this in the culture. That's how we look at the company. When we visit a company, we ask very different questions about, for example, the business model and whatnot. So that's the first aspect. The second aspect is, especially in the Asia universe, and especially pre-COVID, it's rather difficult to get access to the listed companies, to have planned visit, to have a fairly informative sit-down meeting with the management, etc. Usually, the company will send out IR person to not really go into details of what the company does and all that. To them, it's a run-of-the-mill quick conversation because they have to entertain so many requests to visit the company and to talk to the company. COVID changed that a bit more because a lot of the conversation now is online. So whether or not they're speaking to one person or 10 person or 100 person, it's similar. And there's a lot of pressure for the company to open up from the CSRC front, from the regulatory front. So the situation is getting better. But from the private equity angle, what I'm trying to say is, even if we do not get access to the company, we have ways, because we're trained in private equity, we have ways to, for example, get to their customer, get to their supplier, get to their competitor, to understand whether this company is doing well or not. So it is from these two aspects that sets us apart, or set firm with a private equity background apart, that can really dig into the target company very deep and get a better understanding of the target company.
Your team runs a particularly concentrated book. Is this also part of your ethos of taking a private equity approach, in the same vein that you would have run something like this at JP Morgan?
Yes and no. Concentration is a relative term. I do agree that our book, compared to the US standard or European standard, is concentrated. But compared to our counterparts in China, locally, I think we are quite diversified, So for our position, we rarely go over 10%, okay? So a typical position would be like 6-7%, and we let it run a little bit. If it's a good stock that goes up, and we will start thinking about taking profits when it gets to 12% above. So again, that's relative. We are comfortable running those kind of numbers in terms of concentration, but targeting the Asia universe.
So I want to pivot a little bit to, and we can jump back and forth in the conversation, but I'm kind of letting this flow. When you look at stock picking, and generally when we look at the cycle where we're at for stock picking, which is, quite frankly, a lot of the other managers that I'm talking to also feel that this is a fantastic environment for accumulation. And especially with headwinds on the geopolitical scale, we're just coming on the back of policy changes, even within China, that have mitigated some gains on and hurt some of the larger firms. We talked about this in our last conversation before the call, that you felt that this is a great time to start coming back into the market, but not like before. It's definitely an environment where you need to choose and pick, because the tide isn't necessarily rising across all sectors. What did you mean by that?
Well, we say the market is very attractive. Sometimes it's from a comparable perspective, compared to history. But when we spoke last, when we indicated our strong opinion on the market, it's in the absolute terms, actually. There's one screen that we do from time to time, which is for a very attractive target company. One can be PB below 1, for example. There are a lot now. In history, there's some as well. But when we look for below cash companies, they rarely happen in the Asia universe. And when they happen historically, it is, I wouldn't call it fake cash, cash that in a business such as a construction company, where they get lots of down payment, but eventually they have to use those cash in a project that may end in 6 months or 9 months, right? Like pseudo cash, I would call it maybe. But this time, in the beginning of the year, we start to find companies that are really, really below cash. One company in particular is called 𝗁𝘃𝗲𝗁. The company actually is not super sexy. It's in the medical devices sector. But the reason why they have so much cash is because during COVID, they were the first one that got approved by FDA to supply the test kits for COVID. So the moment they were approved, they got government orders from the US, and they generated a humongous amount of cash for them. So that's real cash. That's money earned by them.
So for a case like this, the cash that was raised during COVID, and sorry to jump in here, but I'm thinking about some of the firms, even the biotech firms in the US, where they did extremely well during COVID, but had a massive drawdown over the last couple of years because of the increase in interest rates, which might impact how they look to reinvest in the financing costs of their operations. How does this speak to, how might it be different with Chinese companies or medical device industry?
No, what's happening to these companies that benefited in the COVID era, it's the same. So the stock dropped, the performance on a year-to-year basis, they came down as well. So is this company. Except this company has, comparatively speaking, they generated lots of cash, and the stock price came down in such level that it's traded below cash, which is very rare in the Asia space, okay? And what's important in the Asia space is many Asia company, especially the founder-owned or founder family-owned, if they are facing a market with slight headwinds, they will start to think about new areas to invest in, what's the fashion of the day. And many times, these activities leads to loss-making new business initiatives. But this company, we also looked at it from this angle. They didn't. They put it into wealth management products. They put it in the certificate deposits. So they did not do any very large investments that are outside of their competence. Now, their core business, other than this testing kit, they are also doing take-home test kits, like measuring blood pressure and whatnot. And you can find them on Amazon. So that's their normal business. They are not number one, but it's a real business. It should not be worth zero, for example. So we bought it a few months ago. It has traded up a little bit. They are at cash right now. It's hovering around cash. Still, we think grossly undervalued.
So let's take this example a little bit further. You have a case where they've been able to shore up capital and generate incredible returns, specifically because of COVID. Now we're moving into post-COVID, where demand for their testing kit might come down, etc. And you still have a company that has fiscal discipline on how it manages its cash pile. So I would imagine for this to have future or further growth potential, you're probably looking at how it's going to deploy that capital into other ideas that are evolutionary to its core business. Or is the idea simply to invest on it on the cash basis and then take profit as the market returns? What's your angle here? Are you investing into growth? Or are you investing into RV relative value?
This is a very good question. For this particular company, internally, we will characterize it as a so-so company, but good stock. What we are expecting is the company should at least use a good amount of cash first to do buybacks, right? They should at least elevate to a normal valuation. And obviously, the cash that they have is much more than what can be used for buybacks. In terms of further investment, from our point of view, actually, we prefer them not to do anything outside of their competence. So we will watch them very closely and look for signs if they are using the cash in a way that we are not happy with. So for us, it's more a RV play rather than this is the greatest management in the market, and maybe they can create a second leg and third leg to lead us to the greatest company of the universe. We are not looking for that, yeah.
I think this is a great example. Besides RV, and this seems to be a fantastic environment for that. When you look at policy now, because you are a bottom-up stock picker, what are you paying attention to? Because these policies can potentially shift the investment thesis and the narrative very, very quickly. And I raise this now because as of the time of this recording, technically, Hong Kong at least is in a bull run. We're now up 25% since its bottom. CSI is trailing a little bit. I think it's up 14 to 15%, but they're still breaking a very long 3-year trend and looking like they're moving in the right direction. And this commensurates very much with the fund flows that we're seeing, the monetary easing that's happening onshore. Now, I think I want to segue, obviously, how some of our audience members are going to react to geopolitical risk, but just from a domestic policy perspective, what are you looking at right now?
First of all, I'm not sure what you're referring to. Right? One is the macroeconomic policies. The second is, policies more specific to the equity market. There's also the various policies that's targeting the industries.
So what I'm trying to get a sense is, for you as a bottom-up stock picker, right? You're focusing very much on the fundamentals of the company. You do have a quant screen that kind of screens out excellent companies, maybe better stocks or at least prime stocks. And then from there, you convert to specific firms. Right now, we talked about medical devices. We can talk about consumer discretionary, there's big tech, etc. For you, it seems to be relatively agnostic. But even from a macro level, number one, do you look at macro, right? Do you look at macro factors and how it affects China? And number two, what specific government policies are you keeping an eye on that might affect how you do your valuations or make your plays?
Obviously, macro is half of the game, but in our shop, we do a lot of things, but the primary way is that, as you mentioned, that we have a systematic way of screening companies once the financial data is available. The most recent one was April 30th, which is the deadline for the first quarter, the annual number. So in a normal course of business, We will screen the entire universe. We will get a short list. And the companies come up, they could be in various industries. Some industries may not have a very recent policy that affects it, while others may. So to us, the macro policies is a added work that we have to make sure the company is copacetic with. It's not running against the policy, for example. Obviously, we have a periodic work, try to gauge the macroeconomic policy as well and see if some ideas can come from it. But the primary way is that we get the potential target company first. And when we do the hands-on research, macro is a very important consideration. Let me give you an example, maybe in the real estate sector, which is pretty, everyone's watching it. So the question will be, do we avoid it? How do we participate in it? There's a lot of, quote unquote, stimulant policy that came out in the last 3-6 months. Is it going to turn the page now? How do we participate, right? So we obviously did a lot of research behind it, but by no means we are experts in China's real estate. But the first thing I want to mention is when we look at the real estate route since, I don't know, maybe even 2 years already, year and a half, 2 years coming down, is it going to affect the wider economy? One or two conclusions we came to. One is we don't think the bank will be affected, but no bank will go bankrupt because of this problem. The reason is we looked at the individual households that bought the houses. They take out a loan. There's two differences. One difference is in the West, when the market value of the house goes below the loan amount, the LTV in the industry, if it goes south, in the West, people will just throw the home to the bank, right? Says, forget it, I'm not going to keep on paying for it. But yeah, the regime in China is very different. I think the bank will continue to come after you for the loan, first of all. And secondly, even with the recent real estate price drops, I think most of the household is comfortably below the LTV calculation, so to speak. Okay. First of all, that's kind of the material that we're researching, we're reading. And secondly, we have not seen any news that says now the market there has dropped below the low amount in a certain area. So the conclusion we have is due to this real estate problem, I think the banks are safe, at least. Okay. They may have problems in other areas, but vis-a-vis real estate market in China, they're okay. All right. The right word I will use actually not safe, but in Chinese, there's a word called 伤筋动骨, right? You get a sprain and you have a fracture, right? So even with that, you're not dead, right? So my description of this is no sprain and no fracture. So yeah, you get a cut, you may need a long time to recover, but that would be my characterization of how the bank is going to fare in this real estate problem here.